Good morning, everyone. You are welcome to today's class. In today's class, we shall be discussing the topic. Okay, sorry. So we are taking income tax in this class, income taxation. Okay, so under this topic, or under this course, so we have the following topics. We have accounting standards, then we have administration of company income tax, the scope of company's income tax, computation of company income tax, capital gains tax, administration of personal income tax, and personal income tax on individuals, then payee, that's operation of pay as you earn. Then we also have withholding tax on companies. So meaning the course is mainly on income taxation, and not indirect tax. So there's difference between income tax and indirect tax. Okay, so income tax, under the type of tax, we can categorize or classify those type of tax under the income tax as direct tax. As what? As direct tax. And mainly they could be company income tax. We have personal income tax. We have the petroleum profit tax. So the word income means what you earn from your passive or active income. Okay, so that is the levy imposed by the government, on the income you earn from your either contract of employment or contract for employment. So there's a difference between a contract of employment, and then contract for employment. Okay, so one basically has an employer-employer relationship, and the returns for labor is usually salary or wages. Okay, why contract for employment, has to do with a self-employed person, okay, whose returns or whose rewards for labor will be what? Will be in form of fees, gains, profits, etc. So this set of people are what? Are assessed to tax under the provision of the income tax. So under the provision of the personal income tax, if it is an individual, and if it is a corporate body, then it will be under the provision of the company income tax. Are we together? Hello. So why are we taking accounting standards for? You see, taxation is an arm of what? Of accountancy. Okay, so it's an arm of accountancy. Why? Because if you look at the foundation of tax, so everything has to do with you being accountable, okay? You being accountable to your government, to your chiefs in your community, okay? So because these chiefs or the government, assess you to tax based on what? Based on your business activity, based on the income arising from your business activity. So, and for that to be taxed, yesterday when I was taking the course Principles of Taxation, we spoke about the canon of taxation, where we discussed equity and the likes. And also we discussed the history, a brief history of taxation in Nigeria. Okay, so where we spoke about when the tax was introduced, though it started from the north, but because in the northern part of the country, they have already been paying zakats, which is a tax on their property, tax on their money, on their savings and the likes. Okay, so when the tax was introduced to them, so it was not new. But in the eastern part and the southern part of the country, when the tax was introduced, is something else. Okay, so because it's even led to war. Okay, so it led to war where a lot of things were destroyed, vandalized, and the likes. Okay, because people see it as, why you guys do not participate in our cost of sales, then why should you come and take knife to cut from the revenue? So why should you take knife and come and cut from the revenue when you have not participated in the cost of sales? You understand? So that is, you are not involved in our business. It's not as if you've contributed the capital together and you didn't work for us as an employee. So then why should you come and say we should bring out of our profit and pay to you people as tax for what? And remember the definition of tax, that it is a levy imposed by the government on the citizens. Okay, and the essential of tax is that it is used to run government administration for administration purposes, then also for law and order, so that there will be peace everywhere. So these people that are police, that are army, that are navy, that are air force guys, so all the security defense guys, so they need money too. So they are citizens like us, but they have pledged to defend their country, their country. So we should cater for them because they also have family. They are human beings like us. Okay, so but where do government get money from? So, and tax has been a reliable source of revenue for the government. So now we have accounting standards. There are accounting regulations that guides the way and manner that businesses should prepare should prepare their books. Okay, so if you have an asset, when should you recognize the asset? How should it be recognized? If you are recognizing it, what should be the cost you are putting in your books? So all these check and balances, all these rules, all these guidelines, are brought about by the the International Accounting Standards Board. Okay, IASB. Okay, so then ISB is a baby of IFAC, International Federation for Accountants. Okay, so then this ISB published IFRS. Okay, we have IFRS, then we have IAS. Okay, so now all these accounting standards, let's take it from assets, PPE. Okay, so you have a motor vehicle you are using for your business. So the accounting standard says that, okay, you need to recognize, you have two options. Is either you take the cost model or you take the evaluation model. So if you are taking the cost model, how do you measure it? How do you recognize it? It tells us. Then what depreciation are you charging? Okay, but accounting has depreciation. Then taxation said no depreciation because of the management judgments, because of management biases. The accounting standards allows for management, to decide to choose the accounting standards, to choose the accounting estimates, the accounting policies. So if I have a motor vehicle, I may say that, oh, my motor vehicle will last for 5 years in my books. And gold may say, no, my motor vehicle should last for 4 years. Then Adebimpe might say, oh, no, me, I want it just for 3 years. Motu may choose 2 years. So because of this inconsistency in the application of the accounting standards, or let me say, because each entity has their own unique policy, has their own unique estimates, how they measure these assets, then the tax law says, okay, no problem. We will unify it for you guys. okay, by introducing the, capital allowance. So for capital allowance, it is granted in lieu of what? In lieu of depreciation, but it is uniform. The rate is uniform across entities for all taxpayers, whether you are Dangote or you are non-Dangote. Okay, so that is, if Dangote has acquired the same motor vehicle, the same model, the same motor vehicle for 10 million naira, and you are acquiring your own motor vehicle for 1 million naira, motor vehicle is motor vehicle. If you like, your own should be Passat. If he likes, his own should be what? Should be Lexus. Motor vehicle is motor vehicle. So the rate is what? Will be initial allowance 50%, annual allowance 25%. When we get there, we discuss that better. Okay, so that's just to tell you that the accounting standards and the tax law, okay, have some disagreements, okay, has disagreements in some instances. Okay, so in 2010, there was a reform, because in Nigeria then we were using the national accounting standards. Okay, we have national accounting standard boards, okay, which are, introduce or guide the monitors and issue standards. We call them statement of accounting standards. So we used to use statement of accounting standards in Nigeria before. Okay, so this NASB metamorphosed into what? Into Financial Reporting Council of Nigeria. Financial Reporting Council of Nigeria. Okay, then they adopt what? They adopt the International Financial Reporting Standards. Then ask companies, ask taxpayers, to comply. And because tax is being collected from this company, so the tax authority to also need to what? And there was what's it called? Implementation guide. Okay, there was implementation guide for companies transitioning from the statement of accounting standards to what? To international financial reporting standard. Okay, so now what do we have under this topic? We'll be looking at the impacts of the accounting standards on taxable profits. For instance, now we have IFRS 9, financial instruments. Under IFRS 9, financial instruments, we have what we call expected credit loss. You see, all these model, they are based on what? On management's judgment, management decisions, what management feels, the condition or the situation will be like. But then the tax law, okay, disallow some of these things. When you have impairment loss, the tax law disallow impairment loss. When there is any estimate, okay, when there is any estimate that is not duly supported by what? By the tax law, the tax people will disallow it. So we are looking at the impact of accounting standards on taxable profits, and also we'll be looking at different tax. Then the difference between income tax and and levy under IFRS, which is IAS 12. IAS 12 is basically for income tax. Then the International Financial Reporting Interpretation Committee 21. Okay, so we'll be looking at that. So these are the two things we are looking at. So we are starting with the impact of accounting standards on taxable profit. So by the end of this class, you should understand the impact of accounting standards on taxable profit. Then you should be able to, discuss it in your workplace. So if I may ask, we are all working already. We are all working class, right? Olushola Meshin, good morning. You're welcome to our class. So do you like to be addressed as Olushola or Meshin? Can you please unmute your mic and tell us where you have joined from? Hello, can you guys hear me? Hello, can you hear me? Okay, no problem. Hello, guys. Can you hear me? If you can hear me, please unmute your mic and say yes, or drop a comment in the chat box. So we are taking, as I said earlier, we are starting with the impact of accounting standards on taxable profits. Okay, thank you, Motunde. So, what is accounting standard itself? Before we even discuss the impact, do you understand? So, we need to know what accounting standard is. Like I said earlier, it's like a guide, a principle, a regulation, a rule guiding the what? Guiding the preparation and presentation of financial statements. Guiding what? Guiding the preparation and presentation of what? Of financial statements. So an accounting standard is a standardized guiding principle that determines the policies and practices of financial accounting. And a good example I made use of was that of what? Of motor vehicle, in line with the requirement of the IS 16, property, plant, and equipment. Okay, so the guiding principle for recognizing, measuring and presenting these assets in your financial statements is what? Is accounting standards. Is accounting standards. So as a tax consultant, you need this knowledge. And that's why the institute has, included that in your syllabus. Okay, the institute has done what? Has included it in your syllabus, and it is compulsory for all. So if you are exempted all courses at the foundation level, then you'll be meeting financial reporting at the professional 1 level. Except if you have an accounting background or you are ICAN qualified, then you may be exempted all courses in CITN. Okay, so now, okay, so Adebimpe. Okay, so an accounting standard again is a standardized guiding principle that determines the policies and practices of financial accounting. Then accounting standards are authoritative standards for financial reporting and are the primary source of generally accepted accounting principles. So, because like I mentioned, the IAS or the IFRS, okay, so they are globally accepted accounting principles. They are globally accepted. So they has a wider range of acceptance. The same accounting standard that they are using in Nigeria is what they use in Ghana, what they use in South Africa, and the likes. Though there are some countries that they have their own gap, and their gap is similar to what? Is similar to the provision of IAS and IFRS, like we have in the US. Okay, so we have US gap. We have what? We have US gap. Okay, so then that's that. I hope you all understand what accounting standard is now. Hello, can you please unmute your mic? My class should always be an interactive one. Hello. Hello.
Hi. Hi.
Do you now understand what accounting standard is?
I'm sorry, I got logged out though. I had to be logging in and logging out there, but I will catch up.
Okay.
But I got this one for
Adebimpe,
Spanish.
you were in class. Then Motunde Abbas. Olushola Meshionye. Okay, thank you, Adebimpe. Okay, so please let's try to participate in this class. It goes a long way. Okay, so it goes a long. Let's have interest. Let's show interest, in this course. So section 55, subsection 1 of the Companies Income Tax Act, Law of Federation of Nigeria, 2004, requires a company filing a return to submit its audited accounts to the FIRS, while section 8, 52, and 53 of the Financial Reporting Council of Nigeria Act 2011 gave effect to the adoption of international financial reporting standards. Earlier on, I said in 2010, July 28th precisely, okay, so the Federal Executive Council of Nigeria accepted the recommendations of the committee on the roadmap of the adoption of what? Adoption of IFRS, in Nigeria. So, and this is said to be in the interest of the Nigerian economy for reporting entities in Nigeria, because they have seen that IFRS is now becoming globally accepted. Okay, IFRS is what? Is becoming globally accepted with high quality accounting standards. So, but then they have to do the transition in phases. Okay, so they have to what? They have to do the transition in phases. So they start with the bank first, the banks, insurance companies, or let me say the PLC, okay, the listed company, the quoted company on the stock exchange, Commission of Nigeria. So the council further directed the Nigerian Accounting Standard Board, which later metamorphosed into the Financial Reporting Council of Nigeria. Okay, so under the supervision of the Nigerian Federal Ministry of Commerce Industry, to take necessary actions to give effect to the approval of the Federal Executive Council. So this implies that the audited accounts to be submitted by taxpayer, company, to the FRS after the adoption of the International Financial Reporting Standards shall be prepared in compliance with what? With standards issued by the International Financial Reporting Standard. Okay, so this is in line with the above, that FRS published these guidelines on tax treatment to be given to each of the standards, especially where there are deviations from Nigerian generally accepted accounting principles. So, it's like you are doing your things this way before. Okay, now the government now said, okay, we don't want you to do it in this direction again. Now we want you to be doing it in this direction. Okay, so there should be what? There should be a transition document. There should be what? There should be a transition document. So people are used to this way of doing things. Then you want to change them. You want to change the direction. You want to change the way and manner they do it. So you have to support them. So that's why the FIRS, published these guidelines. Okay, so on tax treatment of what? On the implication, on the impact, the effect of the transitioning. Do you understand? On the effect of what? The effect of the transitioning on companies. So that, because when you are doing IFRS conversion, okay, or you are transitioning from your local standards to the globally accepted standard, okay, so you probably have adjustment issue, okay, so you have what? You'll be having adjusting journal, okay, you'll be having what? Adjusting journal. So, and you'll be restating, okay, so you'll be what? Restating your financial statement. You'll be restating your financial statement. So please sit back, then listen carefully as we take each of these guidelines one after the other. So for every company that is migrating or converting their standards from the local standards to the international financial reporting standard, or the international accounting standard. Okay, so they must comply with the provision of. So please mute your mic. They must comply with the provision of fund. Otherwise, we'll be having transitioning problem. Okay, so now IFRS 1 is for first-time adopter of IFRS. Okay, so first-time adoption of what? Adoption of IFRS. So a taxpayer shall prepare and present an opening IFRS statement of financial position. I hope we all know how a typical statement of financial position looks like. Do we all know how a typical statement of financial position looks like? Have we seen a statement of financial position before? Or let me even put it this way. Have any one of us seen a financial statement before? Hello, Adebimpe, Mubarak.
Yes.
Okay, so that's fine. So I'm talking to the learning people. So now, and in that financial statement, there must be at minimum, okay, at minimum 5 components. Okay, 5 components. And these include 1, the statement of financial position, 2, the statement of other profit or loss and other comprehensive income, 3, the statement of changes in equity, 4, statements of cash flow or cash flow statements, then 5, other disclosure, including notes to the account, including what? Including notes to the account. Okay, so these are at minimum the 5 components that you should have in your financial statements, a complete set of financial statements. Okay, so now when you are adopting IFRS for the first time, meaning that the company has been in business for long, it's not a new company that is just starting. So if you incorporate your company today now and you are starting your business, it is expected that you start with what? IFRS. So in that case, you may not need an opening statement, okay, of IFRS, an opening statement of financial position, because that will be your first set of accounts. And it was after Nigeria has adopted the International Financial Reporting Standards. Do you understand? But for those that are in business prior to the date of adoption of the International Financial Reporting Standard, okay, they are to prepare an opening IFRS statement of financial position at the date of transition to IFRS. So this is the starting point for its accounting in accordance with IFRS. So a first-time adopter of IFRS is required by the standard A, to recognize all assets and liabilities whose recognition is required by IFRS. Not to recognize items as assets or liabilities if IFRS do not permit such recognition. Okay, so IFRS does not permit the recognition of asset or liability when there is where there is no, for assets, when there is no control, where there is no economic benefit, okay, where there is no economic benefit, and where the risk and reward of the assets will not flow to the entity. Okay, so for fixed assets, okay, most especially PPE, so it must be that the asset is owned by the company, it will be controlled by the company, it will be used for the purpose of renter, okay, and if not renters, it will be used for the purpose of production, okay, it will be used for the purpose of production. So that is, the company will be using the assets, okay, the assets will be in use or for what? For rental purpose. Adebimpe, you are raising your hand. Adebimpe, do you have a question? Hello, Adebimpe. Okay. So then also the first-time adopter is required by standard, to reclassify items that is recognized in accordance with previous GAAP as one type of asset, liability, or component of equity, but a different type of assets liability or component of equity in accordance with IFRS, and to apply IFRS in measuring all recognized assets and then liabilities. So the new net asset based on the accounting balance shall not be adopted for minimum tax purpose. Shall not be adopted for minimum tax purpose. So then also, if the retained earnings of a taxpayer, okay, noted. So if the retained earnings of a taxpayer that had previously, paid tax based on what? Based on dividend. Maybe your accounting year end is June. Okay, your accounting year end is June, and don't forget that this was adopted in July. Okay, so though companies transitioning have up to 31st of December 2011, but early adoption is accepted. So if this company has paid tax before the date of transitioning, okay, if they have paid tax before the date of transitioning on dividend, maybe they have paid tax based on dividend for a particular tax year, and this transitioning increase, okay, or the payment of dividend increase. Now they now pay the additional dividend as a result of the adoption of the IFRS. Okay, so after the transitioning date from their retained earnings that relates to the tax year. So the taxpayer shall be subject to additional tax. So what we are saying now is that, okay, maybe you've paid 100,000 before. Now, because of the restatements, because of the adoption of the IFRS, you now declare additional dividend of 50,000 naira. Okay, so you will be taxed on this 50,000. So you will pay additional tax. Okay, you will pay additional tax in line with what? In line with the section 19 of CITA, which spoke about dividends. CITA is Company Income Tax Act. Are we together? So then also we have section 40. We have section 40 of the Companies Income Tax Act. So details of the recognitions and reconciliation must be forwarded to FIRS. Okay, because as at the time of adopting the IFRS, there will be some assets and liability that will be derecognized, while some that are not recognized will now be recognized. So a reconciliation statement must be forwarded to the FIRS by the taxpayer, including all adjustments to opening retained earnings. Okay, including all adjustments to opening retained earnings. Then also all conversion costs, capital and revenue shall be subject to verification by the FIRS before it can be allowed as qualified capital expenditure. The qualified capital expenditure is the basis for capital allowance, for granting capital allowance. So the FIRS do not want taxpayer to rob them. Okay, so and because of that, they are saying that all conversion costs, capital and revenue shall be subject to verification by the FIRS before it can be allowed as qualified capital expenditure, so that people will not go and cook their books and saying that they have this asset, they have that asset, thereby claiming what? Claiming capital allowance. So because of the period it will take to transition from Statement of Accounting Standards to IFRS, okay, so the FIRS, grant an extension of time to file the returns, and the period is just for 3 months. Okay, so 3 months to file their first set of IFRS financial statement and related returns to allow sufficient time to overcome initial conversion problems, because it's not an easy thing. Okay, so they first need to understand the existing standards, then the new standards. Okay, what will be the transitioning effects? Okay, so the implication of adopting each of the standards. So they look at the implication on the management, the implication on the company's operation. This task is also one of the implications they will consider. among others. So that's that. So let's look at how do we present our financial statement. Okay, so IFRS compliant financial statements shall be included in tax returns in line with the Financial Reporting Council of Nigeria. So all companies now, they include, in fact, even with the adoption of the tax formats by the FIRS, okay, taxpayers are still, are required to upload their audited financial statements. Are we together? So, because that also, gives them confidence. Okay, that also gives them confidence because when you are preparing your tax computation, except for when the FIRS people or states internal revenue people, comes around for audit, they don't have that luxury of time to start reviewing your books one after the other. But they believe that once they have your audited financial statement, they have confidence because auditing your financial statement as exact a credibility. Okay. I have a question. Okay, Motunde Abbas. FIRSEA is Federal Inland Revenue Service Establishment Act. Are you writing that? Federal Inland Revenue Service Establishment Act. Thank you. So, where are we? So, because auditing the financial statement, that's a credibility on the financial statement. So the FIRS people also have confidence on it. So that's why they are saying that, okay, when you are filing your tax return, so you say that you have revenue of 100 million naira. Okay, please attach your financial statement, audited financial statement. Let's see that it is that 100 million naira that your auditor reports. Okay, you've claimed that you acquired so asset during the year. Let's see if it is included in your audited financial statement. Okay, so that's one of it. So tax returns under IFRS shall be in line with Section 55 of CITN and should include, in respect of first-time adopters, a statement of financial position as at the beginning of the earliest comparative period when a taxpayer applies an accounting policy retrospectively or makes a retrospective restatement of items in the financial statement. So there is this standard IS 8, which is on accounting policies, changes in accounting estimates, and correction of errors. Okay, so these standards, reading it in conjunction with the IFRS 1 state that there should be a retrospective application of accounting policy. So when a company changes the accounting policy, they have to apply it retrospectively. Okay, but it doesn't apply to accounting estimates. When there is a change in accounting estimate, you apply that prospectively. Okay, that is from the year of change or from the date of change, then going forward. But for accounting policy, you have to apply it retrospectively, like 1 year back. Okay, assuming that particular accounting policy has been in place or has been adopted as at that date. So a statement comparing what the tax effect of IFRS adoption with Nigerian generally accepted accounting principles, GAAP. Then also your financial statement should include a statement of reconciliations from Nigerian GAAP to IFRS. So let's see how you transition. So let's see those assets, those liabilities, those income, those expenses, that you migrate, that you transitioned from NGAAP, which is Nigerian GAAP, to the IFRS, International Financial Reporting Standards. So be transparent in your transition. Let's see what you are, transitioning. So then we have a deferred tax computation. So we also have deferred tax computation. So deferred tax computation may result to either deferred tax assets or deferred tax liability. So we see more of that later in the class. Are we together? Hello guys, are we together? Hello. Are we together? Are you guys there? Hello? Please, so let's make this class an interactive one. Okay, thank you, Mutunde. Okay, so then we also have in respect of first time adopters. So that is after adopting the FIRS. Okay, so subsequently, there should be deferred tax computation. Okay, you should always show deferred tax computation in your tax return. So under the what's it called? Inclusive in your tax return, we be the deferred tax computation. And this deferred tax computation is a statement showing the adjustments made on income statements or total comprehensive income to arrive at accessible profit and total profit for tax purposes as the taxpayer may wish to adopt shall be included. Okay, so there needs to be an adjustment. Okay, there needs to be an adjustment on the accounting profit to what? To adjusted profit or accessible profit. Why? Because a good example is we have depreciation. Okay, which is disallowed for tax purpose. Okay, but it is allowed under the accounting principle. So we disallow depreciation, then we allow capital allowance. But before we allow capital allowance, we would have disallowed depreciation first to arrive at our accessible profit. Also, we also disallow any loss. Okay, any loss on what? On disposal of assets, loss on disposal of assets. And if you have any gain on disposal of assets that has previously been included in the profit of a company, we also deduct it. Okay, we also deduct gain on disposal, gain on disposal. So these are the various, some of the adjustments that we make on the income statement to arrive at our accessible profit and total profit for tax purposes. So because of that, okay, so apart from that, for capital allowance, okay, so where we have unrelieved capital allowance and we have unutilized losses brought forward or carried forward rather, okay, so those ones we also form part of our deferred tax computation. They also form part of our deferred tax computation, and we are comparing our carrying amounts. We are comparing our carrying amounts as per IFRS with what? With our tax written down value. Okay, tax written down value, which is as a result of the application of the tax law. Okay, so the difference between these two will give us what? Will give us temporary differences. So these temporary differences will either result in a deferred tax asset or deferred tax liability. So we see more of that as we make progress in this class. So let's move to inventories. So I hope you all understand our discussion or my explanation on the presentation of financial statements for first-time adopter of IFRS. Hello, do you all understand? Is it clear to all? Please, so answer. Is it clear to all? Mubarak. Okay, so then we are taking inventories. What is inventories? Let me ask you. What is inventories? Farouk Adeshina, you are welcome. What is inventories? Good. Mubarak, Olushola, what is inventories?
Inventories are a list of assets available to a firm or a company. I think something like that.
Okay.
List of it is what is this called? Current and recurrent assets or items that is available in a company or an industry.
Okay. Okay, so simply put, okay, so inventories are those assets, okay, usually current assets, okay, that are used as raw material for the purpose of production or used as what? As work in progress, okay, or used as work in progress, or used as what? Used as finished goods. So work in progress, we could have packaging materials, you know. So yes, we have produced the goods, we have used the raw material, we have converted it to our own products, but then the product is not readily available for sale because we are yet to package them. So let's take, for instance, we use flour, we use milk, we use water, this and that to produce our biscuits or bread. Okay, to produce our biscuit or bread, for instance. So then we cannot take those breads to the market like that. So they are still work in progress. So then we need packaging material. We need all these leather, all these nylon, and the likes. So to complete the process. So after packaging them, putting them in their respective cartons, so they are readily available for sale. So they are finished goods. But if you have not made the sale, they are still in our custody, they are still in our store, then we take them as what? We take them as inventory, but finished goods. Okay, so the inventory will be finished goods. Are we together? Okay, so that's that. I hope it's clear to all. Ambrosia, you are welcome. Good morning. Is it clear to all?
Thank you.
Do you understand that simple definition?
Yes, sir.
Mubarak, Motunde, Olushola, gold.
Yes, yes.
Okay, thank you. So now, what are we looking under this inventory concept? Okay, so what we are looking at now is the tax implication. So we do have allowable input VAT. What are allowable input VAT? Allowable input VAT are the VAT you pay on the acquisition of your raw material. So for those that are in my principle of taxation class yesterday, I did explain this. Okay, so the input VAT, okay, is the VAT you pay, VAT paid on what? On acquisition of, let me just say, vatable goods. Vatable what? Vatable goods or services. Okay, so vatable goods or services. So it then depends. But for goods, let me explain it clear. For goods now, let's take raw materials. Okay, so if you acquire raw materials for the purpose of production, the VAT you paid on the acquisition of that raw material is referred to as what? As input VAT. Then when you are making sale, okay, the VAT you charge your customer is referred to as what? Is referred to as, so let's say VAT received on what? VAT received from the sale of goods or services. Okay, so that's the output VAT. So allowable input VAT is included in the cost of inventories. So where you have included your allowable input VAT in your cost of inventories, it shall be disallowed for income tax purposes and treated separately as deductible from the output VAT as contained in the VAT Act. Why are we disallowing it? After all, IS2 says that the cost of inventory is what is the purchase cost plus any other attributable cost. Okay, is the purchase cost plus any other attributable cost of bringing that inventory to its present location and condition. So if that is the definition, then why are we disallowing input VAT for what? For tax purpose. We are disallowing input VAT for tax purpose because the input VAT can be used to reduce the output VAT liability. Because, for instance, now on your input VAT, on your raw material purchase, you pay VAT of 100 naira. Now, you have converted the raw material to your produce, you have your finished goods and you have sold it. Okay, so and the what's it called? The output VAT you charge on your sales was 150 naira. So instead of you going to the FRS to pay 150, okay, you are not paying 150. We said that, okay, you have suffered 100 naira before. So please take off the 100 naira from the 150 you have to pay us. Then you pay us 50 naira. So if the FRS has allowed that and it has reduced what you'll be paying to the FRS, then you should not be allowed to add this to the cost of your inventories again, because it will amount to double taxation. I hope this is clear. So that shall be disallowed. So when inventories are purchased with deferred settlement terms, cost of inventories shall be based on the cost indicated on the invoice, inclusive of any imputed interest. Again, when inventories are purchased with deferred settlement terms, cost of inventories shall be based on the cost indicated on the invoice, inclusive of any imputed interest. Where such interest has been charged in the income statement, it shall be disallowed for tax purpose. If, however, the interest has been separately shown on the face of the invoice, such interest shall not form part of the inventory. Such interest shall not form part of the inventory, because it should go to your borrowing cost. It should go to your borrowing cost, because interest is an allowable expenses. Are we together? But it should be disclosed separately. I hope you guys are following. So then estimates or provisions shall also not be allowable for tax purposes. So maybe you make an estimate for inventory words. Okay, so maybe let's say write down of inventory. Write down of inventory, or sorry. So write down of inventory or inventory obsolescence. So maybe you are like, let's make provision for this inventory. It may not remain in good condition till the next 5 months or at the end of the next 6 months. Okay, so that will not be allowed. Do you understand? So let's go to IAS 8. This is IAS 8. So IAS 8 has to do with changes in accounting policies, changing in accounting estimates, and then correction of errors. Okay, and correction of errors. So IFRS provides for retrospective application. I mentioned this earlier, of changing accounting policies. The retrospective adjustment shall not be effected for first-time adopters for tax purposes. Okay, so for tax purposes, okay, they will not accept the retrospective adjustments. Though for IFRS, you can do your retrospective adjustments. Okay, but IFRS for tax purposes, it will not be allowed. So taxpayers should submit a recomputation of income tax and deferred tax. Taxpayers should submit a recomputation of income tax and deferred tax. Taxpayers should also disclose all changes in estimates, the basis of computation, and the statement to which it has been charged, and the statement to which it has been charged. So this is for the interest of us of deferred tax purpose. Deferred tax purpose. Are we together? Okay. So again, like I said earlier, any obsolete or obsolete stock of inventories, will not be allowed. So FRS may allow claim on obsolete stock where it is satisfied. I said it earlier that it will not be allowed. Okay, but they may allow inventory obsolescence where they are satisfied that such stock is indeed obsolete. The first one I said was a provision, but we have now come to reality. Okay, so we've seen that the flour has expired. We can no longer use the tomato. Okay, so then to reduce the loss on the company, FRS may allow for the write down of the inventory. So any verification or certification of destruction of inventory stock, carried out without the FRS witnessing such shall not be accepted for tax purposes. So the goods that has expired, okay, you need to take picture of it before disposing them. Okay, before disposing, go and call the FIRS guy. Let them come and be a witness. Okay, let them put it on record that, okay, truly these goods expired and they will be disposed of. Do you understand? Because if not, they will not allow it. They will not allow it. They will disallow it for tax purpose. So FIRS shall assess each correction of error on its merits and in line with the existing laws. So taxpayer shall provide a detailed disclosure of the sources of the errors and the future tax effects of those errors. The other thing we have is IS 11 construction contract. You see, this standard has been remodified. This standard has been remodeled, and it has now, metamorphosed to IFRS 15, revenue from contracts with customers. Revenue from contracts with customers. So this standard, is the combination of IS 11 and IS 18, revenue, which we'll be looking at later. Okay, so the current practice for determining contract revenue by IFRS shall be sustained. So only costs attributable to certified work done shall be allowed for tax purposes in line with the provisions of CITA. Other incomes in the nature of incentive payments will be taxed accordingly. The expected loss recognized as expense shall be disallowed until the loss is actually incurred. Yes, the tax law allows for, offsetting your tax loss, okay, or loss incurred in prior year in the current year. Okay, however, where the loss, arises or resulted from your deduction of expected credit losses or any other provision that deems to be artificial or not accepted by the FIRS, then they will disallow them. Okay, so example include impairment loss. Okay, impairment loss and any other provisioning, such as the CBN Prudential Guideline provision. Okay, so all those ones will be disallowed. They will be disallowed for tax purpose until actual loss, occurred. Okay, until the occurrence of actual loss, then the company will be allowed to utilize it in subsequent years. And also, interest received on advance payments placed in an interest yielding account shall be treated as other income and be subjected to tax at the time it is sent. So if you have fixed deposit that is yielding interest for you, so you have an interest income arising from a fixed deposit. Okay, so if you are not in the business of banking, okay, you are not a microfinance bank, you are not a financial institution, such income will not be taken as revenue. Instead, it will be taken as other income and subjected to tax at the time it is end. So withholding tax, then, okay, so it will be subjected to withholding tax at the point it was end. Also, retention income shall be subjected to tax at the time it is end. Future costs shall not be allowable as expense for tax purposes. So when you have future costs, okay, so that's accrued, and that's what's it called? Maybe for instance, now you pay your vendor in advance, so advance to suppliers or advance to vendor. Okay, so you cannot expense them that year because they have not delivered their obligation. Okay, they have not. Yes, you have your money with them. You can recognize advance to supplier in your other receivables account. Okay, but you cannot expense it in that year. Okay, so the same thing happens to your deferred income received in advance from customers. Okay, so you cannot recognize that revenue in that current year. Instead, you will defer it, and that's what we call it was deferred revenue. That's why we call it was deferred revenue. I hope you guys are following. Hello. So let's go to IS
Yes,
12.
we are following. Sorry, I want to ask a question.
Yeah.
Concerning the withholding tax for fixed deposits. The withholding tax is charged by the bank, right?
Yes.
Okay. Not FRS, not you now paying to FRS, but to the bank.
No. The bank will deduct the withholding tax. They need to. Is that taken?
Okay. Thank you.
So now income taxes. Briefly, taxpayers can furnish FRS with all the tax disclosures as contained in the standard. So we look at it in more detail. Okay, so towards the end of the class. But just know that income tax, under income taxes, we have what? We have current tax. We have current tax, and we have what? We have deferred, and we have deferred tax. So we look at this in detail later in the class. So let's go to property, plant, and equipment. Property, plant, and equipment. So yes, we all agree that land is not a qualifying capital expenditure. Okay, because land does not depreciate, it appreciates every day. So you cannot claim capital allowance on land, never. Okay, so when you are transitioning, whatever affects your land is none of our business. Okay, because it doesn't affect tax too. Do you understand? It doesn't affect tax. No capital allowance on land. Land does not depreciate, rather it appreciates. Even the IFRS standard does not allow for the depreciation of land. So when there is no depreciation, there's no capital allowance. Is that taken? So that's that for land. So the entities should provide schedule of how they apportion the cost between land and building. So for some entity that they attach land to their building, so they should separate land from building, then provide a schedule of the cost of land as well as that of building. So it shall be apportioned, in line with the current market value of the land to the building as at the date of transition, except where the historical cost can be easily ascertained. Except where the historical cost for land can be easily ascertained, then they take the rest for what? For building. Are we together? So then we look at deferred payment for PPE. Okay, deferred payments for PPE. So capitalized cost of PPE shall be based on the cost indicated on the invoice. Capitalized cost of PPE shall be based on the cost indicated on the invoice. So this PPE now is exclusive of land. Okay, so any imputed interest element charged as finance cost on the income statement shall be disallowed. Some PPE, they are on hire purchase. They are on hire purchase. So any PPE that is on hire purchase is only the cost element that we consider under for tax purpose. Okay, it's only the cost element that we consider for tax purpose. The interest income, we go to your statement of comprehensive income. Okay, so because interest is an allowable expenses. Okay, so and it's an imputed cost of charge to finance cost. So it will be disallowed for tax purpose because You have enjoyed it through your through your income statement. We have allowed it. So if you are adding it to the cost of your PPE again, it will amount to double counting. So you can't hit us twice. Okay, so that's just it. So also the company should provide the details of the imputed interest included in the cost of assets for necessary adjustments. So then, some companies, maybe where they are currently, they rented the space. Now they are moving to their permanent sites, and they have to remove all their plants and equipment they are using in that rented space. So the cost of dismantling and removing the item of PPE and site restoration. Provision, estimate of cost of abandonment, dismantling, removing the item of PPE and site restoration shall not be allowed for capitalization with PPE. In fact, this dismantling, removing, and restoration of sites usually happen to companies in the oil and gas, sector, because at times they pollute the area when they are dismantling or removing their PPE, it's caused damage to a lot of things. So the contract they do enter into do state that at the end of their abandonment or dismantling or removing the item of PPE, they have to restore the site. Okay, they have to restore the site. So they will now make the provision for it from day one. Okay, so the FIRS is now saying that the cost shall only be allowed, for tax purposes when it has been incurred. So, as from day one, they has made the provision. Okay, so if, for instance, now what they will pay at the end of 10 years when they are leaving is 10 million naira. So they may start making the provision from year one, 1 million naira, year two, 1 million naira. By the time they get to year 10, they have this 10 million naira in their books. So when they are paying the money, they have the accounts they will debit, and the account they will credit. So when they will debit the provisional account and they credit their bank self-ini account balance. Do you understand that? Okay, so FIRS is now saying that, okay, we are not saying that it should not make the provision, but it will only be allowable when what? When the payment has been made. When the payment has what? When the payment has been made. Or if it is set aside in a funded sinking fund, provided that any company that has claimed deduction on any amount set aside for abandonment, dismantling, removal of sites of PPE, and restoration shall not claim further deduction upon incurring the relevant expenditure, except on amounts incurred in excess of the money set aside for that purpose. So if you are putting your money in sinking fund and they are allowing it for you as at the time you are putting it, so eventually, maybe after the end of the term, contract term, you now incur more than what you have put in your sinking fund. Okay, then it is only the excess of the money set aside for that purpose that shall be allowed. Okay, but where you have less than that, adjustment will also be made. Okay, but what we are saying is that if, let's say, what you later incur is exactly what you have saved for, okay, in your sinking fund, then the FIRS will not allow further deduction. Okay, there's no double counting. Also, any amounts claimed in excess of that expended or for the abandonments, removal of items of PPE and site restoration shall be treated as taxable income. As I've said this earlier. Then we move to exchange of assets. So, companies may exchange assets. So where there is exchange of dissimilar assets, the old asset shall be treated as a disposal. So we are not saying that when you exchange motor vehicle for motor vehicle, okay, but we are saying now that you exchange motor vehicle for plants and machinery. So where there is exchange of dissimilar assets, the old asset shall be treated. So we assume that you sold the motor vehicle, okay, with the sales proceeds being the market value of what? Of the plant and machinery you acquired. So that would be the price at arm's length of the assets you exchange it for. Then balancing charge or balancing allowance, value-added tax, and capital gains tax shall be computed accordingly. So balancing charge and balancing allowance is what is the balancing charge and balancing allowance is what is the difference. Okay, so when we have asset disposal, so we call it balancing adjustments. Okay, we call it balancing adjustments, which could give birth to what either balancing charge, or what or balancing allowance. So it cannot give birth to twins at the same time. Okay, so it's just one charge. It's either balancing charge or balancing allowance. So balancing charge is when the sales proceeds is what is more than the carrying amount of the assets, and balancing allowance is when the sales proceed is less than the carrying amount of the assets. That's the tax written down value. We discuss that later as we progress in this class. So also the cost of the new asset for capital allowance purposes shall be the market value of the old asset plus any cash consideration included in the exchange. So if the market value of the motor vehicle you exchange for plant and machinery at the date of exchange is say maybe 50 million naira, then you now add 20 million naira. So the total cost of this plant and machinery will be the market value plus the additional money you added, which should now be 70 million naira. Is this clear? Hello, Shoye.
Yes.
Is that understood?
Yes, sir.
Okay, hope you are following.
Yes.
Then we have revaluation surplus or deficit. Cost and tax written down value is the basis of capital allowance computation. I mentioned this earlier. So FRS shall continue to disregard all revaluation of PPE. That's true. That's what we have in practice. And any revaluation surplus shall not be taxable, while deficit shall not be allowable deduction. So whether you have gain or loss on revaluation is none of our business. Where you have gain on revaluation, okay, so this should be what? This should be taken to what? It should be taken to your other comprehensive income. And when you have loss on revaluation, okay, you take it to your profit or loss, depending if this is coming or arising for the first time. Okay, maybe that's your first time of revaluation. So the loss will be taken to income statement, then the profit will be taken to other comprehensive income. And where there is subsequent revaluation, gain or loss, then you adjust accordingly. So when you have subsequent gain, you take to the income statement to the extent of the previously recognized revaluation loss. Then the same thing goes for loss too. You take to the other comprehensive income to the extent of the previously recognized gain. Then any differences, okay, maybe any excess will be recognized accordingly. I'm talking too much, sorry. So we are in tax class. Then we have professional fees and valuation expenses. Professional fees and valuation expenses relating to revaluation of PPE shall not be allowed for income tax purposes. Shall not be what? Shall not be allowed for income tax purposes. Why are we not allowing all this? The reason we are not allowing all of this is because of the provision of the Capital Gains Tax Act. Okay, so the Capital Gains Tax Act allows for deduction of professional fees and valuation expenses from what? From the sales proceed. From what? From the sales. So we call them what? Cost to sell. They are part of cost to sell of assets. Okay, so before arriving at the capital gain, on which there will be 10% capital gains tax. Am I talking sense? Okay, so these expenses should be separately disclosed. Where such expense is incurred prior to sale, it shall be deductible from chargeable gains under capital gains tax. So don't say that we are cheating you. Okay, so everything is here and there. Then we move to componentization. Oh, before componentization, I missed that in my notes, no problem. Okay, so we have the depreciation of land used as quarries and landfill. The second schedule to CITN does not recognize any form of land as qualifying expenditure. So therefore, capital allowance will not be granted until the relevant tax laws are amended. And then for spare parts and servicing equipment, stock of spare parts and service equipment should continue to be carried as inventory and expensed when consumed. They call them what? Returnable, e.g., for instance, we have returnable containers. So when you consume them, you can call them consumable spare part and servicing equipment. So then where replacement results in improvements, the cost shall be added to the tax written down value of the PPE, while the carrying cost of the replaced part that was expensed in line with FRS shall be added back in arriving at the assessable profit. Then also we have replacement costs. I hope you guys are taking note of all of this. For replacement costs, it shall be treated as a liable deduction if it does not result into improvement. So we have one, improvement costs. And we also have what we have replacements. We have replacement costs. So what's the difference between the two? Can someone tell us? Kindly unmute your mic to speak.
The improvement cost that when you prolong the life of the asset. Why replacement cost just because it's permanent?
It's like you're having network issue from where you joined us from. So is there any other person that wants to try?
I would say that improvement cost is an expense, while replacement cost can be an asset.
Okay, so improvement costs can either be an expenses, okay, that will be expensed through the what? Through the statement of profit or loss. And at times it can be capitalized. Okay. So it will be capitalized if the improvement cost, let's say is in capital in nature. Okay. So in fact, most likely it will be capitalized. Okay, because the word improvement means that you have possibly increased the useful life of the assets. Okay, the useful life of the assets, or probably you have increased the, let's say maybe the capacity before is 1,000 units. Okay, so now you have increased it towards 1,005 units. Do you understand? You have increased it to 1,005 units. So these are examples of improvements in the assets. So it could be improvements in the useful life, in the estimated life of the assets, or its efficiency use. So like I said, most likely it will be capitalized. So it will only be expensive if it is minimal. And if it is minimal, we will not even consider it as improvement. So it will just be repairs and maintenance like that. Then replacement cost is that you are removing that particular, for instance, now maybe let's say motor vehicle. You have your engine. Okay, you have your engine. So the engine running in the motor. So you are removing it completely. Then you are bringing new one. Probably the engine has been wear out. So then you are now replacing it with the new one. Then using motor vehicle as an example too, for improvement costs. So the engine has weared, but then you don't have the money to replace the engine. So you just call your mechanic that, okay, I'll guide me look at this thing, what can we do to it? And he tell you that, okay, don't worry, we will block the engine, we will use piston, we will use this, we will use that. So at the end, when he was after finishing his own work, he has ringed the engine, put piston and the likes. The engine now sound as if it's a new one again. So all the smoke has disappeared, is now working perfectly as if it is a new one. Meanwhile, it is not a new one, but there is a major repair. Okay, there is a major repair. So now you can now use that engine for the next 2 years. You can now use that engine for the next 2 years. So you have extended the useful life of the engine. Is this clear? Hello, is it understood?
Yes.
Okay, so replacement costs shall be treated as a liable deduction if it does not result into improvement. If it does not result in, but if it results into improvement, then the cost shall be added to the tax written down value of the PPE, while the carrying cost of the replaced part that was expensed in line with FRS shall be added back. So going back to the example of the motor vehicle I used, now if we can estimate the cost of the piston, okay, the cost of the ring the mechanic is using, in the engine. Okay, so then we take those costs. But if it is not possible for us to estimate the cost, then we rather take it as what? As an expenses. We will not capitalize it. Because if you are doing capitalization, except, in fact, for the engine itself, that's why when you are taking motor vehicle, you take it as one. So for the engine, if we can, what's it called? Identify the cost of the engine we are replacing, it is fine. We are replacing the total engine. So, and that one is easy to know. As at the time we acquire the motor vehicle, we can just say, okay, what is the likely cost of the engine as at the time we acquire the motor vehicle? Then we, we use that. But for maybe partly repaired or the major repair of the engine. So if it is not possible for us to estimate the cost of the piston, the ring, and the likes that we are putting in the engine, we just take it as what? As repairs and maintenance. Are we together? Okay, so we move to IFRS 17. Financial lease. This IFRS 17 has been superseded by what? By IFRS 16. By IFRS 16, accounting for leases. So under IFRS 17, we have two types of lease. We have the finance lease and we have the operating lease. For finance lease, in line with IFRS classification of lease assets, there could be a situation whereby an operating lease becomes a finance lease. Okay, so an operating lease is a lease that is just within 12 months for a short period of time. Let me put it that way. Then a finance lease is a lease that is more than 18 months. Okay, so where two parties have correctly applied the old principle, but are now compared by the FRS standard to reclassify operating lease as finance lease, then the FRS will rely on the tax written down value of the assets in granting further capital allowance to the lessee. In granting further capital allowance to the lessee, because when you are reclassifying from operating lease to finance lease, it means that because under operating lease, it is the owner of the asset that enjoys the capital allowance. But under finance lease, it is what? It is the lessee. Okay, it is the lessee that enjoys the capital allowance. Do you understand? So we are not saying that when we are reclassifying the operating lease, to finance lease, so we are transferring the capital allowance from the lessor to the lessee in this case now. So we will take the asset we will transfer at the tax written down value from the lessor to the lessee for the purpose of granting the lessee further capital allowance. So also investment allowance and initial allowance shall not be granted to the lessee on reclassification of the assets. In fact, the Finance Act of 2022 has abolished the investment allowance on plant and equipment. But as it is in our notes, investment allowance and initial allowance shall not be granted to the lessee on reclassification of the assets. Then where there are errors in compliance with previous standards on leases, the tax consequences resulting from the errors shall be adjusted for tax accordingly. Then also, for assets reclassified as finance lease, paragraph 18 subparagraph 2 and paragraph 3 of schedule 2 of CITA, which relates to right to claim capital allowances on finance lease shall apply. Then also the guidelines on finance lease as described in IFRS Information Circular of 2010, which relates to VAT and withholding tax shall also apply. Then for operating lease, so investment allowance, initial and annual allowances are claimable by lessor. Okay, so are claimable by lessor on cost of the asset, less capital installments paid before the reclassification. Then annual allowance is claimable by lessor on tax written down value. We discussed this of the capital portion of the lease installments paid. The one we discussed here now is the operating lease, changing to the finance lease. But now we are discussing the finance lease changing to operating lease. It means that the lessee will no longer enjoy capital allowance again. So it's transferring it to the lessor. So the same thing that applies to the lessee under the finance lease happens to the will happen to the lessor too under the operating lease. So an allowance is claimable by the lessor on tax written down value of the capital portion of the lease installments paid. Then for assets reclassified to operating lease, paragraph 18, subparagraph 1 to schedule 2 of CITA, which relates to rights to claim capital allowance on operating lease, shall apply. Then also FIRS Information Circular number 2010, dated 12th April 2010, guidelines on tax applications of leasing, which relates to VAT and withholding tax, shall apply. The lease rental payments to be recognized for tax purposes each year shall be the amount incurred or realized. Again, the lease rental payments to be recognized for tax purposes each year shall be the amount incurred or realized. So incurred will be to the what? To the lessee, then realized will be to the lessor. So why the lessee take it as what? As an deductible expense, the lessor will take it also as what? Allowable income, taxable income, taxable income. So it will be taxed in the hand of the lessor. Are we together? So before I take questions, so let me just conclude on this IS 17. Let's look at lease of building. So where a building is put on lease under operating lease or finance lease, the existing tax treatment subsists. Okay. Then for sales and leaseback, transaction that results in a finance lease. Do you know what sale and leaseback is? Hello, do you know what sale and leaseback is? Hello, what is sale and leaseback?
I don't know.
Okay, no idea. Farouk, good. Olushola, Motunde, Mubarak.
You don't know.
Okay. So sale and leaseback transaction refers to, now let's take for instance, I have a motor vehicle, Lexus 570. Okay. Then I need money. Okay, I need money, but I like this car and I still want to be using it, but I need money. Then I don't want to just dispose it of pata like that. At the same time, I do not want to go to bank to borrow money. So what I do is to make an arrangement with someone that I trust. Okay. So I just call Motunde. That Motunde, I want to sell this Lexus 570. But then after I sell it to you, I will still be using it. Okay, so you now be the new owner, but I'll be using it. And I'll be paying you for the use of the assets. Okay, I'll be paying you for the use of the motor vehicle. So I've sold it to you, but it will still remain in my custody. And then I'll be paying you rental payments. Okay, so I'm leasing it for the next 1 year. I'm leasing it for the next 2 years. So I sold it out to Motunde for 70 million naira. Okay, I sold it out to Motunde for how much? For 70 million naira. You know, Motunde has paid me the 70 million naira. Now, I will be able to use the money for whatever I want to use it for. Then, I still need the car. Okay, so the arrangement with Motunde is that, okay, you lease this car for me. Every year, I'll be paying you 5 million naira. Every year for using the car, I'll be paying you 5 million naira. Okay, Motunde accepts. No problem. We are good friends. Okay, so I'm paying Motunde what? I'm paying Motunde 5 million naira. So if after some years, I cannot afford to pay Motunde, okay, so I can now tell Motunde that, okay, Motunde, this car, remember the arrangement, so let me buy it from you back. Okay, let me buy it from you back. So that one is sale and lease back. Okay, that will later result to buying the assets again from Motunde. Okay, but in some instances, it may remain in lease forever until the asset is no longer useful again. Okay, so I've sold it to Motunde for 70 million naira, then I'm leasing it for 2 million naira, for 2 million naira every year. So that's sale and lease back. So I sold it, but it doesn't leave my premises. I still own the control of the asset. Okay, then I'm paying Motunde at least. So the sales and lease back transactions shall be treated separately for tax purposes, and relevant tax provisions shall apply. So when you sell it, we treat it as disposal of the asset. Then when you lease back, we treat it as lease back of the asset. So as you are paying Motunde lease payments, Motunde will be paying withholding tax on the lease income. Then I will also be able to, expense. So this position is based on the provisions of the FRS Information Circular on Lease of 12th April 2010. Also, the disposal shall be treated in line with the provision of Schedule 2 of CITA on capital allowance, balancing allowance, and balancing charge. Then, we've said as we are treating it as what? We are treating them separately. So we treat the sales as disposal. So therefore, any gain or loss on disposal shall be subjected to the provision of the Capital Gains Tax Act. Remember, we don't allow gain or loss under the Companies Income Tax Act. So it is provided for under the Capital Gains Tax Act. Then also, the finance lease shall be treated separately in line with the above guideline on finance lease. The yearly amortization of profit on disposal into profit or loss shall be treated as what? As non-taxable income, So that's the sale and lease back transaction resulting into finance lease. So for operating lease, the existing tax treatment on disposal, operating lease, VAT and capital gain tax shall be applied on the transaction. Then for tax purposes, the higher of sales price and market price shall be taken as disposal value. And lastly, the actual lease rentals paid shall be adopted for tax purposes. Okay, so any question before we move forward, before we move to the next subtopic? Hello, any question? Hello, any question? Hello.
No question.
No question, you can continue.
I hope you guys are enjoying and understanding the class.
Yes.
Small.
Okay. Okay, Motunde, thank you. Okay, so we take revenue. I said earlier that the standard for revenue has changed. So we now have IFRS 15, revenue from contracts with customer. Okay, so in the case of deferred consideration, where imputed interest is embedded in sales revenue, the entire value of the invoice will be subjected to tax. However, where the interest element is clearly shown and separated on the invoice, VAT should not apply to the interest portion. VAT should not apply to the interest portion. And also, where the interest element is clearly shown and separated on the invoice, the interest element shall suffer withholding tax at the rate of 10%. So, where there is different consideration, some people used to embed interest in the sales. So where it was not separated or where it was not shown clearly or separately on the invoice, then the entire value of the invoice will be subject to tax. But where it is separated, then you subject only the interest portion to withholding tax. So for income tax purpose, both the sales and finance interest income constitute taxable income. Then the taxpayer must always disclose clearly the component of deferred consideration, the component of deferred consideration. So we move to employment benefits. So employment benefits is IAS 19, and this has to do with long-term benefits accruing to employee in an employee-employer relationship. So provisions in respect of other long-term employee benefits other than post-employment benefit and termination benefits? What are examples of post-employment benefit and termination benefits? Examples of post-employment benefit and termination benefits. Ambrosia, Gold, speak.
Termination benefits.
Okay.
I think
Like,
maybe when the company
so
wants.
you don't know pension, you don't know gratuity.
Termination benefit. I think post-employment benefit is pension and gratuity, But termination benefit is the one that the employer gives.
Pension, gratuity. Like
Termination benefit is compensation for loss of employment.
Yes.
So any termination benefits, or any other long-term employee benefits that are not due to be settled within 12 months after the end of the period in which the employees rendered the related service shall not be allowed for tax purposes until actual payment is made. So profit sharing and bonus payments shall also be allowed for tax purposes in accordance with Section 24D, subsection 2 of CITN, which states that cost to the company of any benefit or allowance provided for the senior staff and executives which shall not exceed the limit of the amounts prescribed by the collective agreement between the company and the employee and approved by the federal ministry responsible for labor matters as the case may be. So any bonus payments, okay, you receive from your company, it is taxable. The LRS will tax you, will deduct it from you. Okay, so you pay tax, you pay pay on it. So also your company will be allowed to claim it. Okay, so they'll be allowed to claim it as allowable deduction. So that's that. Then personal income tax is payable on bonus and profit sharing in the hand of the recipient in line with the provisions of Personal Income Tax Act. In line with the provision of the Personal Income Tax Act. Are we together? Okay, so we have interest-free loan. So benefit on interest-free loan shall be taxed based on one, when it relates to individual. Okay, so and when it is a corporate taxpayer. For individual, it shall be regarded as benefit in kind and taxed under the provisions of Personal Income Tax Act. Then for company, it shall be treated in line with the provisions of the Income Tax Transfer Pricing Regulations of 2012 and the Section 22 of CITN. So in all cases, both for companies and individuals, the interest rate to be used shall be in line with the Section 32 of the FIRS Establishment Act So the benefits associated with, other short-term employees benefits, such as complementary goods, services, reduced priced, auctioned assets, at below the carrying cost, among others, shall be treated as benefits in kind in the hand of, the beneficiaries or recipients, and shall be treated in line with the provisions of the Personal Income Tax Act as amended up to date. So we move to IS 20, accounting for government grants and disclosure of government assistance. Accounting for government grants and disclosure of government assistance. So we have capital grants and we have income grants. So where taxpayer decides to use the government grant to reduce the cost of the asset, then the carrying amount after the deduction of the grant shall be available for capital allowance purposes. Okay, then when the deferred income approach is chosen, then the income shall be taxed when realized. So the grant may be used to reduce the cost of sales or expenses of the taxpayer, but where the taxpayer opts to recognize the grant as income in the statement of profit or loss, then the income shall be taxed accordingly. So this government grant is usually granted to, people where they have incurred capital, expenditure. Okay, so if they incur the capital expenditure, then they might take it as capital grants. But where it has to do with income or expenses, so maybe for instance, there's a donation they did, or they did a project that they expense in their books. Okay, so the income they receive from the government shall be used to, reduce the expenses they incur. And probably if the income absorb all the expenses, and the remaining, the balance shall be taken as other income and taxed accordingly, depending on the circumstance. But where the company choose to recognize it as income, okay, instead of using it to reduce the expenses, the expenses will be allowed, and also the income will be subject to tax accordingly, So we move to IS 21, the effect of changes in foreign exchange rates. So the presentation currency for the purpose of tax returns shall be the Nigerian currency, except as otherwise provided in the tax law. So for instance, now, when you are paying your VAT, okay, VAT shall be paid in the currency of transaction. So if you have transacted using US dollar, you pay your VAT with US dollar. If you have transacted using UAE dinar, okay, or dirham, so you pay VAT based on that too. But for income tax purpose, okay, when you are reporting in another foreign currency, okay, so you have to translate to your Nigerian currency, except if you are a foreign company that does not have a fixed base in Nigeria. Okay, so all returns shall be presented in the presentation currency, which is to be Nigerian currency, Naira, except as otherwise provided in the tax law. So the currency for tax assessment shall be in line with the provisions of the relevant tax laws. Exchange difference on settlement of monetary item is a realized exchange difference. Okay, so the loss shall be allowed while the gain is taxable under CITN. So we have two types of exchange difference. So it could be exchange gain or loss. So, and we have realized exchange gain or loss, and we have unrealized exchange gain or loss. We have realized exchange gain or loss, and we have unrealized exchange gain or loss. Are we together? Okay, so any form of unrealized gains or loss arising from foreign currency transaction or translation shall be disallowed for tax purpose. So for instance, now, this one is on settlement, okay, but the IFRS says that when you are translating your currency to your presentation, your financial statement to your presentation currency, so you are translating all your items of statement of financial position at the closing rate. You are using what? You are using the closing rate. So if you are using the closing rate, it means that there will be what? There will be translation differences. So any gain or loss resulting from translation will be disallowed for tax purpose. But any exchange differences arising from settlement of monetary item, maybe for instance now, you acquire motor vehicle from Canada. Okay, so your vendor is in Canada. So the total cost of the motor vehicle is, let's say, 10,000 Canadian dollar. Okay, so 10,000 Canadian dollar. So now, as at the date of purchase, you were only able to afford 7,000, Canadian dollar, 7,000 Canadian dollar. So in that case, now you are owing the vendor 3,000 Canadian dollar. So this $3,000 now is sitting as payable in your books as at the end of the year. Okay, it's sitting as payable in your books as at the end of the year. Or let's even say before the end of the year, you eventually pay it. So at the end of the year, it's not shown as payable, but you do not pay it at the spot. I mean, at the date of transaction, you pay it in the later date. So let's say this transaction took place on 1st of April. Okay, on 1st of April, and you later settle the debt on 30th September, of the same year. But at the time you are settling the payments, in your books, this 10,000, this 3,000 balance as at April is equivalent to what? Let's say it's equivalent to 30,000 naira. It's equivalent to 30,000 naira in your books as at April. So as at September that you are now making the payments, as at September that you are making the payments, Naira has what? Naira has falling, and you are now settling at what? At 40,000 naira. So there is a loss of what? There is a loss of 10,000 naira for you. So this is a what? This is a realized exchange loss, and it will be allowed for tax purpose. But unrealized exchange loss or exchange gain is the one arising from translation of translation from what? From fractional currency to presentation currency. Are we together? So let's move to borrowing costs. So under borrowing costs, interest on loan incurred on any qualifying capital expenditure that is under construction shall be capitalized with the cost of construction of the asset, while the interest on the loan after the asset is fully constructed shall be expensed. So the weighted average cost of borrowing, okay, that is the cost to borrow the fund adopted in line with the IFRS, shall be used to determine the proportion of interest on the general purpose loan that relates to the capital asset for capitalization and capital allowance purposes. So where any part of the borrowed fund is put in an income yielding account, so the interest income you are receiving shall be disclosed, and this will be taxed accordingly. So if the capitalization of borrowing cost is also suspended at the period when it's in its active development, okay, so the active development is interrupted and charged to income statement, it shall be disallowed for tax purposes in line with the second schedule of CITA, So we also have accounting and reporting of retirement benefits plan. Okay, accounting and reporting of retirement benefits plan. So we have pension schemes, superannuation schemes, retirement benefits scheme. Okay, retirement benefits scheme, among others. Okay, so which are all in line with what they are treated as allowable what expenses for tax purposes in line with our in line with the Pension Reform Act, if I'm correct. In line with the Pension Reform Act, I think we have Pension Reform Act of, is it 2021 now? I'm not sure. Okay, so or 20, is it 2014? Okay, so that's so income derived by any company formed for the purpose of managing pension or any retirement benefits, as scheme shall, be taxable under the provisions of the relevant tax law. Then we have investments in associates and joint ventures. So upon disposal of investments, okay, upon disposal of investments in associates or joint ventures, the gains arising therefrom shall not be chargeable under company income tax, and any loss shall not also be deductible. Instead, it will be charged under the capital gains tax Act, So the withholding tax suffered from dividend received from investments made in associates shall be the final tax in the hands of the recipient. So we move to IAS 36, impairment of assets. Taxpayers shall be required to make the following disclosures in its tax returns. 1, the schedule and detailed computation of impairment losses recognized in profit or loss statements, and the schedule and detailed computation of impairment losses on revalued assets recognized in other comprehensive income and income statements as the case may be. So also, reversal of impairment loss is not taxable and should be adjusted for the purposes of determining the company's assessable profits. Also note that all impairment losses charged to the company's income statement shall not be allowed for tax purposes. So impairment loss is also treated as what? Like depreciation. They are both not allowed for tax purpose. So no adjustments shall be allowed to the net assets in the financial statement for the purpose of computing minimum tax. So we take IAS 37. Any question before we proceed? Any question? Are you guys following? Olushola, Farah.
Yes.
Yes, yeah, I would say.
Okay, thank you. So IS 37, provisions, contingent asset, and contingent liabilities. So existing tax treatment of not allowing provisions and estimates as deductible expenses remain unchanged and shall continue to apply. Then as for the commissioning costs, we've taken this under IAS 16. So any provision, estimate of cost of abandonment, dismantling, removing the item of PPE and site restoration shall not be allowed for capitalization with PPE. So the cost shall only be allowable for tax purposes when it has been incurred or it is set aside in a funded sinking fund. So we've taken this. Okay. So let's move to IAS 38, intangible assets. So the intangible assets which meets the requirement of qualifying capital expenditure should be capitalized. So we have different types of intangible assets. Included is computer software, customers list, franchise, trademark, and website calls, all the likes. Okay, so math ed and the like. So we have computer software. Software that forms integral part of a computer shall be treated as qualifying plant expenditure, while standalone software will be treated as intangible assets and amortized over the useful life of the assets. Again, software that forms integral part of a computer shall be treated as qualifying plant expenditure, while standalone software will be treated as intangible asset and amortized over the useful life. An example of a standalone software is QuickBooks. Okay. So an example of a standalone software is all these Microsoft Office software like Office 365 and the likes. So then we have customers lists. Customers list acquired as an intangible asset by a taxpayer to the extent that it is for the purpose of generating taxable profits, shall be tax deductible via amortization over the useful life. Where the intangible asset have indefinite life, then no tax deduction should be allowed. So under IS 38, so an intangible asset could have a useful life and could also have an indefinite useful life. So an asset that has an intangible asset that will have an indefinite useful life must be that it is possible or it is not practicable. Okay, it is not practicable, to determine the useful life of the asset. And where it is not practicable to determine the useful life of the asset, then the asset will be taken as an indefinite life with an indefinite life. Okay, but where it is practicable to determine the useful life, then it shall be determined accordingly. We have franchise. This shall be expensed over the useful life of the franchise. Research and development. The position of the Company Income Tax Act on research and development shall continue to be applied. So R&D costs charged to profit or loss, other than those allowed under Section 26 of CITN, shall be disallowed for CIT purposes. Then we have website costs. Okay, so any website cost that meets the condition of capitalization shall be amortized over its useful life. However, website cost that is expense shall be subject to deductibility test. And then costs relating to internally generated intangible assets shall be disallowable for tax purposes, except as provided under the second schedule of CITN. Okay, so then we are still on intangible assets. Intangible assets such as landing rights, import license, radio station license, etc., acquired through government grants for free or at nominal value are either recognized at fair value or at nominal value and shall be treated as follows. Where 1, it is an intangible asset that has a nominal value. The value shall be adopted for tax purposes. 2, it is at fair value and the nominal value exists. Then the difference between these values shall be disallowed for tax purposes. The difference between the two values shall be disallowed for tax purposes. 3, fair value is used and nominal value does not exist. The fair value shall be disallowed for tax purposes. The fair value shall be disallowed for tax purposes. So any disposal gains on intangibles shall not be taxed under CITN, but taxed under the Capital Gains Tax Act. Taxed under the Capital Gains Tax Act. So we move to investment property. IP, investment property. So taxpayers shall split land from building. Split what? Land from building. See, this is similar to what we did under the IAS 16, property, plant, and equipment. So the taxpayer shall disclose the rationale used in apportioning or separating land from building with a certified valuer's report. Where the ownership of an investment property gives rise to a separate line of business, any income from this new business will be considered as a separate line of business and thus taxed as a separate line of business in line with the provisions of the tax laws. So we have some companies that have a special purpose vehicle, SPV company, okay, that they use to run their investment property. So this company own the investment property on behalf of other related entities. So on disposal of investment property with tax written down value, the relevant provisions of the tax law shall apply for capital gains tax and CIT purposes. However, on disposal of land which does not qualify for capital allowance, only the provision of the Capital Gains Tax Act shall apply. Only the provision of the Capital Gains Tax Act shall apply. Are we together? Hello, are we together?
Yes.
Yes.
Okay. Also, all assets other than land, all assets other than land that are reclassified, okay, from investment property, or let me pick it this way, that are reclassified from PPE. They are reclassified from PPE to what? To investment property. They are reclassified from PPE to investment property, shall be transferred at their tax written down value to investment property and continue to enjoy capital allowance. Okay, so vis-a-vis, the same thing goes for PPE that are transferred to investment property that are transferred to PPE. So where the property is rented out, some of these real estate companies, they let out their property. So where the property is rented out as an investment property, VAT is payable except when it is used for residential purposes, e.g. staff quarters. So benefits in kind would be recognized in the computation of personal income tax. But the Finance Act of 2020, 21, 22, discussed the issue of VAT on the rental property, okay, on investment property. So it has excluded land and building from what? From the VAT, okay, from VAT. So land and building are no longer subject to VAT where they are rented out under investment property, okay. So is there any other attachments like land market, any other thing that is attached to land, okay, so they will be what? Taxed accordingly. So we move to IS 41 agriculture. So the activities of deep fish trawlers shall be regarded as agricultural business in accordance with Company Income Tax Act. Capital allowance and other tax incentives to agricultural business shall continue to be granted in respect of deep fish trawling assets. Okay, deep fish trawling assets. So then again, IS 20 again and again, government grants. So we then add this to the earlier notes. So government grants shall be treated for tax purposes in line with the position of the IS 20 government grants. then the grant is liable to tax when it is received, whether they are conditional or unconditional grants, whether they are conditional or unconditional grants. So if, however, a conditional grant that has been taxed is withdrawn, probably due to a breach of a condition, then the amount withdrawn shall be allowed for tax purposes. And any penalty for default or breach of condition shall not be allowed as a deduction for tax purposes. So if I may ask you, what's the difference between a conditional grant and then unconditional grant? What's the difference between the two? And unconditional grants. What's the difference? Oh yeah, what's the difference between the two? Motunde, Mubarak, Gold, Ambrosia.
I think a conditional grant has a clause attached to it. Maybe when this condition is fulfilled. I don't know. Why unconditional grant doesn't have any clause attached?
Okay. Thank God you use your English knowledge.
Yes.
Please try it. You write that in the exam. If the allotted mark is 5, please you should get nothing less than 3. Because you use the English language clause. So yes, there must be what for a conditional grant. It means that there is an asset, for instance, maybe what they plan to do is to use the money for the less privileged. Okay, maybe to support them in school or and likes. So if that is the purpose of the grant, the money must be spent for that purpose. Okay, the money must be spent for that. Another thing I need to add to you guys, I need to tell you is that anything you are doing in task, when you are writing any exam, if you know you understand the concept, apart from defining or giving the definition of that particular concept, please always put example. Just say, for instance, e.g., for example. So it adds to your mark, meaning that if your definition is not comprehensive or is not well detailed, without e.g., without for example, without for instance, so that further explanation or illustration will give you an added advantage. Okay, so maybe in your definition, what you score was 2. Okay, so if the examiner or the marker understand your explanation, that example you give, okay, he or she may add 2, and before you know it, you've gotten 4/5. Do you understand? So then for the unconditional grants, is that you can use the money for anything. Okay, so you can use it for anything. So there's no condition to be satisfied. Do you understand? So that's that. So let's move to IFRS. So all we have been taking since is IAS, International Accounting Standards. Okay. So now we are taking IFRS, which is the International Financial Reporting Standards. So they are both accounting standards and they are both called standards. Okay, so under this we have share-based payments, which is IFRS 2. So we've taken IFRS 1. That's first time adoption of accounting standard. First time adoption of IFRS. That's IFRS 1, first time adoption of IFRS. So IFRS 2 now is share-based payments. So capital allowance shall be claimable if the asset acquired is a qualifying capital expenditure. So the cost of the assets, purchases, or expense is the invoice price upon which VAT provision shall be applicable. So then any related expense involved in the issuance of shares under share-based payments shall be disallowed for income tax purposes. So share-based payments means that you are paying with the company's share. Okay, so you are using the company's shares to pay. So at times companies do share-based payments for their employees. So they may do it for a vendor, to settle the payments and the likes. So, okay, maybe for instance, they acquire some set of computers from you and they don't have money to pay you. So instead they can, issue you shares in their company, and they use the money they are owing you as the money you use to acquire those shares. Then we move to business combination, IFRS 3. So business combination is like merger, okay, acquisition, and then takeovers. Okay, so just to put it simple, okay, so just see them as a merger, acquisition, and takeovers. So all tax issues arising from business combinations and merger shall be treated in accordance with IFRS Information Circular of 2006. Okay, so on the implications of mergers and then acquisitions. So goodwill impairment charge to the statement of comprehensive income or statement or income statements shall be disallowed for tax purposes, while goodwill acquired shall not form part of the qualifying capital expenditure on which capital allowances can be claimed. Then also gains arising from the disposal of a cash generating unit with goodwill components would be subjected to capital gain tax. Again, gains arising from the disposal of a cash generating unit with goodwill components will be subjected to capital gain tax. Are we together? Okay, then we have insurance contracts. So the tax law has not changed as a result. The provisions specified under Section 16 of CITA are still operational. Okay, are still operational. However, the tax law has changed. Okay, but as at the time the study test was prepared, it hasn't changed. Okay, so I'm just taking you through what you probably come across in your study test and the reality. Okay, so the Finance Act of 2020, okay, the Finance Act of 2020 abolishes the, let me take it this way. Before 2019, okay, there used to be restriction. There used to be what? Restriction on the deductibility of losses brought forward, taxable losses, okay, or taxable loss, brought forward for an insurance company. But the Finance Act of 2019 has abolishes this by now saying that, okay, all insurance companies can now carry forward their loss indefinitely, carry forward their loss indefinitely, So it means that the restriction has been removed and it is no longer applicable. So they can now enjoy carrying forward their losses indefinitely. Are we together? Okay, so then also we have the section 16 of CITA. So that one has not changed. Okay, so because insurance business under company income tax are seen as specialized business. They are seen as what? As specialized business. They are seen as specialized business. So, and that is taken in your final level. We call the course income tax for specialized businesses. We call it income tax for specialized businesses. Income tax for specialized businesses. Is that taken? Okay. So then we move to IFRS 5, asset held for sale and discontinued operation. So in IFRS, it used to happen that where a company, choose to sell their assets, choose to dispose of their assets. So maybe, for instance, now they have a plant and equipment or a building that they are using for the purpose of production, okay, for office purpose or for production purpose. Now, it's no longer required. Okay, so, and before now, it used to be under the PPE, IES 16, property, plant, and equipment. So they need to do the reclassification. Immediately after they have agreed with the board, after the board of directors have agreed, they have reached the conclusion that, okay, we are going to put these assets for sale within the next 12 months. So, and it is realistic that these assets will be sold, will be, disposed at within the next 12 months. Okay, so, and they can also determine the amount they will sell it. So they are very sure that there is an open market for the assets. So owners demand that they do reclassification from PPE to IFRS 5, okay, which is asset held for sale and discontinued the operation. So the FRS shall take any assets classified as held for sale and discontinued operation under IFRS not to be in use and shall suspend capital allowances on it until what? Until otherwise proved. Because they have do the reclassification from PPE, so they can no longer claim capital allowance on the assets. When it is under PPE, they do claim capital allowance. Now that they are doing the reclassification from PPE to asset held for sale and discontinued operation, so the assets will be transferred at the carrying amount, okay, to IFRS 5, and this will be taken under the current assets, under what? Under current asset and not non-current assets. So it will be reclassified, and as does the capital allowance claimable on it when it was PPE will no longer be claimable. Are we together? Am I talking sense? So let's move to IFRS 7. Okay, but before that, let me just add to what I've said under this IFRS 5. So now, I mentioned earlier that there must be an intention and the board must be sure that there is an open market for it. The assets will be sold within, will be put to sale within the next 12 months. Okay, so if now by peradventure they were unable to sell the assets, or probably there was, we have new presidents now. This decision was made as at 1st January, 2023. Now we have a new president. Okay, and the new president has said that some sectors need to be cleaned up. Okay, so because of that, the board now reconsider their decision, the earlier decision they had to reclassify to IFRS 5. So they now said that, oh, let's continue our business. Don't let us discontinue this operation. So this building that we want to put to sale, let's take it back to the business. Let's bring back our people. Let them continue working because we have a renewed hope. Don't mind me. I'm not a politician. So I'm just using it as an example. Because we have a renewed hope. So they are now bringing the assets back to PPE from what? From IFRS 5. Okay. So if that's successful, okay, then they can now start claiming back their capital allowances, and the capital allowances will be granted on the tax written down value. Is this clear? Hello, Shoye. Sorry, is it understood?
Yes, sir.
Hello. Then when the asset is eventually disposed of, then we apply the provision of the Capital Gains Tax Act. Then for discontinued operation, that okay, we are not doing business again, we have new president. So we cannot cope with this president. We are jacking, we are leaving the country for them. We discontinue our operation. So then we apply cessation rule. There's something we call cessation rule. We apply what? Cessation rule. So this shall be applied to the discontinued line of business. And the commencement rule we apply if the line of business is bought over by another party at arm's length in line with the section Section 29, subsection 9 of of the Company Income Tax Act. So IFRS 7, IFRS 9, IS 32, and IS 39 are added together. We added together. So in brief, they are all financial instruments. Okay, so they are all deal with financial instruments. We could have financial asset and financial liability. So financial instruments classified as what? Fair value through profit or loss, held for trading or short-term profit taking, such as derivatives, are revenue in nature and therefore liable to CITN to the extent that they are not specifically exempted from tax. Also, the transaction shall be taken as a separate line of business, except where the taxpayer is already engaged in the same line of business. Is already engaged in the same line of business. Then financial instruments held to maturity investments such as debt securities and mandatory redeemable preference shares are capital instruments. Consequently, capital gains tax shall apply to gains derived from the disposal of such instruments, except for gains exempted by relevant provisions of the Capital Gains Tax Act and regulations. Also, financial instruments classified as loans and receivables is to be treated in line with the provision of the other relevant tax laws. And then also, financial instruments classified as available for sale. Financial instruments classified as what? Available for sale, that is, it has a default class, such as equity instruments, not measured at fair value through profit or loss. Not measured at what? Fair value through profit or loss are capital instruments. They are what? They are capital instruments. So capital gains tax shall apply to gains derived from the disposal of such instruments, except for gains exempted by relevant provisions in the Capital Gains Tax Act and regulation. I know you may be wondering, you may be thinking in your mind that, hey, is it everything this guy is reading that we have to cram like this? And this is just chapter 1 of the whole syllabus. Anyway, all you just need to do is to read and understand. Read and what? Read and understand. You don't need to cram. Okay? You don't need to cram. So that's that. Plenty. So we have compound instruments and we have preference share still under the financial instruments. So FRS shall regard this compound instrument as what? As a pure debt. So nominal instrument is not, interest is not allowable for tax purposes, but actual interest incurred should be allowed for deduction. And as for preference share, the FRS is in conflict with the provisions of Companies and Allied Matters Act. Therefore, any payments made in respect of preference share shall be treated as what? As dividend until the provisions of CAMA are what? Are amended. Until the provisions of CAMA are amended. So we move to IFRS 8, operating segments. So operating segment is like you having a business now. So you have a department or a unit that basically what they do is bread, and they account for their revenue separately. You have another unit that basically what they do is biscuits, and they account for their revenue separately. Okay, so you also have another arm that basically what they do is what is changing, and they account for their revenue separately. Another one, does granules, and they account for everything separately. Okay, so this is an operating segment, this is also an operating segment, and this is also what? An operating segment. So they are all operating segments. So in line with IFRS 8, and looking at the impact tax on pass. So irrespective of the segmentation criteria adopted by the taxpayer, only segmentation based on lines of trade or business shall be acceptable for tax purposes. So like this one now, based on trade, bread, biscuits, shin, granules will be allowed for tax purposes. Then we have IAS 10 and IAS 27, consolidated financial statements. So in line with the existing Nigerian tax laws, separate income taxes is computed and charged on every line of business or subsidiary. The other one we took was IFRS 3 business combination, okay, where we spoke about merger and acquisition. But this one are considered financial statements. So in a business combination, there will usually be most time a parent and subsidiary relationship. So when there is a parent and subsidiary relationship, in line with the tax requirements, okay, so there's no consolidated financial statement. You prepare if you are the parent company, you prepare your financial statement, submit it to the tax office. separate financial statements. And if you are the subsidiary, you also prepare separate financial statements. So the consolidation is for accounting purpose. Do you understand? So in line with the existing Nigerian tax law, separate income taxes is what computed and charged on every line of business or subsidiary. So there is no group taxation in Nigeria. Group tax. For where? No. Even if you are a family, the father should pay the tax, should pay his tax, the mother should pay his tax, and then the children, as much that they are, taxable in Nigeria, they should also pay their tax. There's no family tax. I just use this as an example. So there's no group tax. Are we together? Okay. So if that is clear, any gain or losses made from disposal of cash generating units or subsidiary with goodwill components, okay, shall be subject to capital gains tax in the hands of the parent company. However, where the acquisition is fully share-based, there shall be no tax implication. In fact, recently, the Finance Act of 2022 also, allows for exemption where there is a share disposal and the share disposal is used to, the proceeds from the share disposal was used to acquire another shares, okay, is used to acquire shares in another company. So capital gains tax cannot be applied. So then we have joint arrangements. Joint arrangements effective 1st January 2013. There are joint venture activities. Okay, so there are joint venture activities. So joint venture activities shall be taxed in the hands of the individual joint venturer in proportion to their individual investments in the joint venture. So under joint arrangement, we have joint operation and we have joint venture. So joint venture activities shall be taxed in the hands of the individual joint venturer in proportion to their individual investments in the joint venture. Then we have fair value measurements. So all gains and losses that may arise from fair value measurements shall be disregarded for tax purposes. So taxpayers shall furnish FRS with all deferred tax as contained in the standard, So we have IS 12 again. Why? So basically, IS 12 prescribes the accounting treatment for income taxes, which include all domestic and foreign taxes that are based on taxable profits. And remember, I said that under income taxes, we have two types, and they are current tax and deferred tax. Okay, and deferred tax. So current tax for current and prior periods is, to the extent that it is unpaid, recognized as a liability. So recognized as a liability, then any overpayment of current tax is recognized as asset. Any overpayment of current tax is recognized as asset. So current tax liabilities or assets for the current and prior periods are measured at the amount expected to be paid to or to be recovered from the tax authorities. So using the tax rates and tax laws that have been enacted by the end of the reporting period, So IS 12 requires an entity to recognize a deferred tax liability or, subject to specified conditions, a deferred tax asset for all temporary differences with some exemptions. So temporary differences are those differences between the tax base of an asset, between the tax base of an asset or liability, tax base of an asset or liability, and what? And its carrying amount, carrying amount. So it's the difference between the tax base of an asset and liability and its carrying amount in the statement of financial position. So tax base of an asset or liability is the amount attributed to that asset or liability for tax purpose, and it is usually called tax written down value. Okay, so again, tax base of an asset is that amount attributed to it for tax purposes. So for tax we have capital allowance, so which is deducted from the cost of the assets to arrive at the tax written down value. So the tax written down value of an asset is the tax base for deferred tax purpose. Are we together? So, so a deferred tax liability arises. A deferred tax liability arises if an entity will pay tax if it recovers the carrying amount of another asset or liability. And a deferred tax asset arises if an entity, one, will pay less tax if it recovers the carrying amount of another asset or liability, or has unused tax losses or unused tax credits. Unused tax losses is taxable loss. I mentioned this earlier. Then unused tax credits is what? Unutilized capital allowance. Okay, so that's all on the accounting standards. Okay, so and finally we move to deferred tax and the difference between income taxes and levy under IFRS. Are we good to go? Time fast spent. Should we call it a day? Or you are still enjoying the class? Hello.
I'm enjoying the class.
Okay. So if you are enjoying the class, no complaints. So let's keep moving. So we have IS-12 again. Why is it IS-12? IS-12, IS-12. Yes. So everything has to do with IS-12. Then because we are discussing income tax. So we look at the accounting standard. Which of the accounting standards, basically talks about income tax. Okay. So it's only IS-12 that basically what talks about income tax. So then under it, we have the current tax and we have the deferred tax. So for the current tax, it is straightforward, but deferred tax, there are some technicalities around it. So people usually do not understand how to prepare a deferred tax computation. So deferred tax asset and deferred tax liabilities, are measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled. So based on tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. I'm coming back to this. So the measurement of deferred tax liabilities and deferred tax assets reflects the tax consequences that would follow from the manner in which the entity expects at the end of the reporting period to recover or settle the carrying amounts of its assets and liabilities. So deferred tax assets and liabilities are not discounted. They are not what? They are not discounted. So let's do a simple test. Again, in understanding this paragraph, let me take it again. Deferred tax assets and deferred tax liabilities are measured at the tax rates that are expected to apply to the period when the asset is realized or the liability is settled based on the tax rates and tax laws that have been enacted or substantively enacted by the end of the reporting period. Now, the Finance Act of 2019, states that, or let me say, categorize companies into three groups. Okay, one, we have the large companies or companies, we have the medium companies, and we have the small companies. So for the purpose of time, the large companies are those companies with revenue threshold, okay, of what 100 million naira and above. So the applicable tax rate is at what? At 30%. Why the medium companies are those companies with revenue threshold of between 25 million naira and what? And 100 million naira. So the applicable tax rate is what? Is 20%. And for companies, small companies who has revenue of between 0 naira and 25 million naira, or you say 25 million naira and below, the applicable tax rate is 0%. So if this paragraph is not saying that it's based on the tax rate and tax laws that have been enacted or substantively enacted by the end of the reporting period, for a company test, simple test, for a company that has turnover of 120 million naira, what is the applicable tax rate to apply in computing the deferred tax asset or liabilities? For a company that has a turnover of 75 million naira, what is the applicable deferred tax rate? And what is the applicable tax rate for the purpose of deferred tax asset and liabilities? Then companies with 14 million naira turnover. So what's the applicable tax rate? So, yeah, answer me. Yeah, let's do it together. So the first one, what's the answer? What's the applicable tax rate?
30%.
Eh?
30%.
30%.
120 million.
Then the next one, what's the applicable tax rate?
20%.
20%. Then the last one, what's the applicable tax rate?
0%.
0%. Why 30, why 20, and why 0?
You have 100 million above is 30%. So we have
Okay.
120 million here. And the next one is 25 million to 100 million. It's 20%. Now, the 20% on top of the 120 is not up to 25. So, and 75 million falls within the range of 25 million to 100 million. So it's 20%. Then 40 million is not up to 25 million. So 0 to 25 million is 0%.
Okay. So when you are computing your deferred tax assets and liabilities, okay, so you look at the company's revenue, then you use that to determine which tax rate are you applying, for the purpose of deferred tax asset. You see, before the Finance Act of 2019, it has always been a straightforward thing because the only tax rate we have then is 30%, except for small companies who are in the agricultural business or within their first 4 years of operation that use 20%. Okay, so when they have 1 million naira, the annual, okay, that was the first. Now I have three different rates, 0%, 20%. It's then depending on the category of your revenue. Okay, so let's take the adjustments classification of asset. So please, when you go to your study test, read more on these deferred tax and difference between taxes and taxes. Okay, so to have more understanding. So in fact, for everything we have discussed, so you can. So that has been my advice to all my students. If I can. Okay. So after the class, after this class now, take your time to listen to the. Then also go to your study tests. Okay, read it and do the practice for sure. There's nothing that can stop you from not, passing the diet. Okay, so and that's been one of the, let me just say, method used by my students that I even use best graduating. So I also encourage you to not say. So then let's look at the audit adjustments for the classification of assets, liabilities, and expenses. Please mute your mic. They are not speaking. Hello. Please mute your mic if you are not speaking. Thank you. Okay. So we have the International Financial Reporting Interpretation Committee Standard 21. So the Interpretation Committee 21 provides guidance on when to recognize the liability for a levy imposed by government. For a levy imposed by government, for a levy imposed by government. So both for levies that are accounted for in accordance with IS 37, provisions, contingent liabilities, and contingent assets, and those where the timing and the amount of the levy is certain. So the interpretation covers the accounting for outflows imposed on entities by governments, including government agencies and similar bodies, in accordance with laws and regulations. So, but this does not include income taxes. So fines and penalties, fines and other penalties or liabilities arising from emissions, trading scheme, and then outflows within the scope of other standards. So the interpretation does not supersede the IFRS Interpretation Committee 6, that is liabilities arising from participating in a specific market. So then we also have other obligating events, So the IFRIC 21 identifies the obligating events for the recognition of the liability as the activities that trigger the payments of the levy in accordance with the relevant legislation. So for instance now, let's say the government asks you to pay a particular levy. Okay, so you have to make provision for such levy. So the IFRS 21 provides the following guidance on recognition of the liability, to pay such levies. One, the liability is recognized. The liability is what? Is recognized progressively. The liability is recognized progressively if the obligating event, occurs over a period of time. If the obligating event occurs over a period of time. Then two, if an obligation is triggered, on what? On reaching a minimum threshold, then the liability is recognized when what? When that minimum threshold is reached. When the minimum threshold is reached. Are we together? So the same recognition principles are applied in interim financial reports. So the IFRIC 21 does not deal with how to account for costs arising from the recognition of a liability to pay a levy. Okay, so instead, other standards are applied in determining whether the recognition of a liability gives rise to an expense or an asset, and that's IS 37. Okay, so provisions, contingent liabilities, and contingent assets Okay, so the standard has an effective period of January 1st, 2014. So initial application in line with the requirement of our 8 accounting policies, changing in accounting estimate and errors, is allowed. Okay, is allowed. So that's all. we have successfully come to the end of the class. And if you have any questions, okay, I'm here to assist you with that. Hello, any question? Hello,
No question for now.
no question. So does that mean you all understand everything that was discussed in the class? Well understood.
Yeah.
So, any question? Alice Dabo. Good afternoon. You didn't join with your mic, so you're unable to speak. Okay. Okay, in the absence of any question, so thank you guys for joining us today. Once again, if you have any of your colleagues that is writing CITN, please feel free to introduce IoT CITN class to them. So let them also benefit from these free classes. Okay. So I wish you guys best of luck in your coming exams. Do have a successful and wonderful diet ahead, and do enjoy the rest of your holiday. Bye.
Thank you.
Thank you.
Thank you so much. We appreciate it.